how do you get money? What are the different ways that you can actually get loans or pay for a storage facility? Because there's more than simply just going to a bank. I've said this a million times. People, for some reason, do not understand. These are not ATMs.
Yeah.
This is a business. This is a long-term game. So you need to make sure that you're working with private money and partners that are in it to build a business, and realizing that there are times where the market not only goes sideways, it tanks. With that said, that is the beauty and the great part of partnering with people. You are giving other people the opportunity to do the same thing you're doing, risking your money, and you can now get capital to do more. Welcome everybody to Self-Storage Income. Today we are talking about financing. Like, how do you get money? What are the different ways that you can actually get loans or pay for a storage facility? Because there's more than simply just going to a bank. So we're going to hit on these and walk through them so you guys know options and what they mean.
Exactly right, man. So I'm excited to dive into this today with everybody. It's something that we get asked about a lot. There's a lot of folks out there that you want to get into storage, you want to buy that first facility, or even that second, third, fourth. And you're like, dude, where do I get the money? How do I structure these things? What is all this different random stuff? Because you'll also find that you're not the only one with questions. When you learn these things, you're going to go out and talk to sellers and to brokers, and sometimes you're going to have to educate them on what these things are and what they mean and how they work, and show them that these are viable options. You know, creative finance, very viable options that put a lot of sellers in a great position and allow you guys to have a great position as a buyer, all of that as well. So excited to dive into it, man. The first thing, let's dissect seller carry first and foremost, man.
Perfect.
What do you want to just give everybody a rundown? What is seller carry? How does that whole situation work?
Yeah, so seller carry is like seller financing. And this is a fantastic method to get your first deal, or even during times when financing's hard, like we're in today. So sometimes like seller financing is almost non-existent, like sellers won't do it. Storage is an industry that is particularly good for this because we have so many mom and pops that have owned facilities for so long and they built them for so cheap. Now, this was something we used a lot, especially after 2008 when banks just didn't work. What it means is essentially the seller is the bank. So if I'm going to put 30% down, right, I would give that money to the seller, and then I would pay for the remaining of the loan to the seller. Let's say you're buying that facility for $1 million and they have a $200,000 loan on it. The down payment is 20%, $200,000 pays it off, and then there's no debt on the property, but then you owe the remaining to the seller. Right? Now, these can be constructed in lots of different ways, and most of the time the sellers, they don't understand this option. So the first thing that I want to say is don't make this complicated. Most people approach this, they scare the sellers, they make it really, really hard. But this is a fantastic option for sellers. Why? I use our 3-option strategy where I go, okay, listen, right now today, interest rates are really, really high. So you want $1 million. But if I have to finance this thing, I can't afford it. I can't pay you $1 million. I can only pay you $800,000, let's say. And the seller's like, but it's worth more. That's true. Because like if you look at a cap rates don't include debt, anything else. But for a buyer, that doesn't matter. I actually have to pay interest rate and it can't afford it. So I say, all right, let's go. I'm just going to straight up pay you for the facility cash. You take care of everything. I can pay you $800,000. Option 2. We may do like a mix of a seller carry and I get some bank financing. They would have to take second position, but we can do that and maybe I'll pay you $900,000. But if instead you carry the note, I can pay you that $1 million. We give you $200,000 down, you pay off the bank, and then I'll make payments to you. Now, why? I'll explain to you how to approach and talk to a seller about this. You don't want to make this complicated, but that option when you're doing the seller carry, The reason why this is really good for sellers lots of times is they can avoid a lot of taxes. So they can pay off the loan. Then they're getting residual monthly payments. They don't have to do anything. And they're getting paid for that facility. Let's say, though, they had no debt on it or even less, then okay, that's great. I still pay you that. You pocket that money. That gives you something right away. Then you carry the remaining, right? There's lots of different ways to do it. Now, when you talk about sellers or talk about seller carry or seller financing with sellers, the first thing is do not jump into, and I mean this for you too. You may be like, I don't know how to do this. Well, first of all, don't go walking in saying, I'm going to pay you a X interest rate, and then we're going to do, a 20-year AM and all, don't start talking all of that. When we approach sellers and they have this problem, it's worth more, can't, I have very little debt on it, no debt on it, then we simply say, well, let me ask you this. What are you needing? And we've done this on multiple facilities. One of the facilities, perfect example is, I need to pay off my house here because I'm moving, but I need the money so I have cash flow to live, right? Okay, well, how much do you need? And they're like, I need $3,000 a month, right? And then I need $150,000 to pay off my house or whatever, and to give me enough money to move. So we said, well, we'll make you a deal. We'll give you the $150,000 so you can leave the Northwest, head down to Arizona, because they obviously wanted to get in the sun. Who wouldn't? And so we do that. And then we will pay you that $3,000 a month. And in, let's say, 4 years, we'll then pay you the remaining balance of it off.
That balloon payment.
That balloon payment. Then we'll pay you the full rest of the amount. So they get the money they need to take care of all the stuff, the money that they want, out of it. Then they're getting that money that they need a month. This is great for us. We don't have a bank, right? We can pay lots of times much less than you would need to for a bank. So when you look at financing, for example, banks require a lot down. So across our portfolio, our LTV, our loan to value, is like 50%. So we have very little debt on our assets. That's for a few reasons. First of all, because you don't want to put a lot in it. But two, banks will not let you. Like banks aren't going to let you. In storage, you can really, you're talking 30% is a minimum unless you use another option, which we're going to go over. But we put down everything that we buy, we put down over 30%, like 40, 45%. So we don't want them encumbered, and we don't want to have a lot of debt on them, but banks won't allow you. You can't do it. Like the system won't even let you. So when we look at that, seller carry, they may go, oh, well, I can put down 10% or 15%. Then the payment, which is what they need to live or not, could be substantially less than the payment we would have to go to a bank. You also avoid lots of fees. So this can be really, really good for both parties. Now, the things to do and not to do. So that's how you have the conversation, right? Approach to that. There's 2 rules that I have with seller financing that I tell everybody. There's 2 things I don't ever want you to break. First is, do not personally guarantee the loan, ever. Now, if a seller comes and says, well, hold on, you're not going to personally guarantee, but a bank would make you personally guarantee. The reason is because if I do the seller carry, I do not have federal protection. There is so much protections against the banks that protect me. Banks can't do lots of things. They have very strict requirements. The government really regulates them and saying what you can and can't do. When you personally guarantee to a seller, none of those things are ever included. It's a civil matter, meaning they could sue you because they just want the money. It exposes a lot of risk to you that they could go after your assets and do different things like that.
That's a really good point. And in making that point to them that, okay, well, you're not a bank and you're not providing those protections.
I always say, I'll do it if you provide me all the protections that I receive from the federal government, the FDC, the states, everything else like that, which they would never do. Why would you? That is not beneficial to them. And so, and that's obviously logical. If you get that, you also have to provide me with what I would get if I did a seller financing. The next thing, when that term comes due, let's say it's a 2-year, 3-year, 5-year, sellers generally don't want to go very long. So like, I want to get my money eventually, right? We put in there that we have to have financing options available to us, and they have to be within similar range. Meaning, when that balloon payment comes due, let's say it's at a 3% interest, and all of a sudden interest rates went to 15%, and you're like, I can't get a bank loan. And the seller's like, I don't care. You give me the money, I'm now taking the asset or everything else. So that protects you to where if banks shut down like they did in 2008, interest rates skyrocket, that all of a sudden you're not trapped. You're not like, I'm going to lose the asset or something like that. Those are the two main things that I care about. Lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. They're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. We have them help us underwrite deals for our students and others. They are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class. It's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. Those are my two absolute rules. The third one I think is equally important, is how it is done and administered. That means you use a third party. So you use a title company or a third party that does all of the administration. I'm not sending the seller a check.
No, yeah.
It is going into escrow. They handle it and manage it. And I do not allow the seller. You just can't call me up and say, I want money. You have to work with the third party, and they administer it per the contract. You don't get to call us up. Where's my money? You can't harass us. You can't cause problems. You can't say I'm worried. No. There has to be separation. Those three things make for a great product. And generally speaking, we've really never had an issue ever with that when dealing with people. They like it too.
Yeah, it's been very smooth.
A very professional third party to administer this and handle it. One of the things that I think people get lost on is they're like, I don't know this stuff. I wouldn't even know how to. Once again, you don't need to. Figure out what you're putting down, how much you're going to pay a month, and then have an attorney, right? Write that seller carry contract or that seller financing contract up based upon those things with those three rules in it.
Yep.
That is what's important. And two, you can work backwards if you need to put it in, meaning you need $3,000 a month. Okay, here's what that means as an interest rate. You can, that stuff you can figure out and put in. Focus on the basics, the small things, what the seller needs, build it out that way, have an attorney write the contract, get those three key things, first two, non-negotiable, that you put in, have a title company administer it, and you're good.
Dude, I love this because that's a really, really common question that we see a lot of times is, okay, seller carry, seller finance, how do I go and have that conversation with the seller? And what do I create to go and present to them? I was like, dude, you don't need to do any of that. Go and talk to them and figure out what they need.
Yes.
It's like sales 101, right?
Yes.
Like figure out what they need and meet their needs.
And then meet their needs, keep it very simple.
Yeah.
If you start negotiating interest rates and all of these different things, first of all, the vast majority of sellers that are in this position are mom and pops. They don't have a lot of debt. They're going to go, I don't get this. This is complicated. I'm scared. Don't.
Yeah.
If you keep it simple and say, hey, this is a deal between us, we're working out that stuff, they can figure out legally however it needs to be administered, right?
Yeah, no, and there's a couple things I wanted to dissect in there too, as you talked about being in second position. Couple things. Do you want to talk about what that meant? And then also, what if you had a seller that's like, I want to be in first?
Yeah. So the banks will never let you be in first. So if you're doing that in between, meaning that I'm going to go get a bank loan to give you the 30% down. You're going to carry the rest. The banks, some banks won't do it at all. Other banks will. We've had banks that'll do it. But the bank will never not be in first position. Meaning, if something goes wrong, the bank gets their money first. The seller gets it after. And that is key. They have to be in second position. No bank is going to allow them to not be in first position for that 30% money that they gave you to put down.
Exactly right. The other thing I want to talk about, let's say you're talking to these sellers and they've already got a broker involved. Is the broker still getting a fee? Like if you're doing seller finance, how have you seen those things get structured?
So good brokers will realize, and they will actually help you with this, but a lot of brokers, they don't like this at all. At all. They don't want to talk about it. They don't want to mention it. Well, they feel like they're going to get cut out. And two, they feel like there's more complexity. So the risk of it not closing is higher. You have to remember the deal closing is more important than anything else to the broker. The broker making more, the fact that it sells more is marginal. But that deal not closing means they make zero. And they make zero for all the work and effort because they only get paid when it closes. So deals falling out is common, and it's been common for the last 3 years. You engage seller financing. Now we have to have all these talks about the seller financing portion. That means it takes longer, bad for brokers. The longer it takes, they're still working for free. So even if they're like, I could sell it at less or sell it at more with seller financing, the time alone that it takes may reduce that profit that they would have made for it selling more is just gone. So we find that brokers in general, they won't even bring it up. They won't tell the seller, they won't bring it up. Good brokers understand that this is a vehicle to actually get a deal closed. Because what could happen otherwise is the seller's like, hey, I'm getting 800,000. I wanted $1 million. I can't get that. I'm just going to take it down. So working with the broker to say, no. We can get the seller their price. That actually then helps you and allows the deal to close. And good brokers will see this and understand that as an option and as a vehicle for them to close the deal.
Makes sense.
But huge amounts of brokers, I'd say the vast majority, they will not even talk about it with the seller. They won't bring it up. They
like,
say,
no.
You ask them, say, hey, I'd like this option. Immediately like, no, we're not doing that. And I'm always like, wait, you say you're not, but you didn't even propose it to the seller. That's why.
How's the seller feel about it?
So
no, and it seems like there's a lot more flexibility too in the seller finance world, where if you're working directly with the bank, it's like our way or the highway. So I feel like
complicated. There's fees you don't know. There's more risk. Seller financing, it's simple. Here's what we're doing. Here's how it's built out. Here's the payment, how it's going to work.
Dude, underwriting can take forever. All the different
it's way less risk than a bank. Seller financing and seller carry is a great option, not just for you buying, but also for the seller. The taxes they avoid, the ability to get higher prices, their ability to get what they need in the moment and then have consistent cash flow. Because a lot of them look at it and go, okay, I'm going to sell it. What do I do with the money? I then have to reinvest it. I have to, all of that kind of stuff.
Right. Let's talk a little bit about too this idea of, let's say in the seller carry situation, I've got this quote unquote, let's just throw random things out. I've got a 20-year AM and let's say it's a 5-year balloon.
Yeah.
What does that mean? And what are things that I should be planning for? For that 5-year balloon, should I save up that capital to pay it off? Should I plan on refinancing that? Or
most people work? So if the balloon payment just means I'm paying 30% down, the 70% is due when the balloon payment, when the rest of it is due. So if I had $1 million deal, right, and I put the money down and the loan is 800,000. At the end of the 5-year term, I have to pay the 800,000. AM is how it's amortized out. So the length that it's amortized out, which changes the payments. So obviously, if you shortened it up, the payments become astronomical because of how it has to be paid. And so people, they don't do that. You amortize it out for 20, 23 years. And this is even with banks, right? This is how it works. And then the balloon payment is different. The balloon payment is when it all comes due. Most people, especially in short time frames, they need to go get another loan. and put a perm loan on it, which replaces that seller financing because you can't save up enough money at the time to pay it off.
Makes sense. Makes sense. Yeah, I had somebody asking me about that recently about like, what is balloon payments? I'm seeing all this stuff about balloon payments. Seems like a really common thing. And it's like you were talking about, it's a way for that seller to get their money.
Yep.
And it's a way for you to get some lower payments, having that longer amortization, but having that balloon payment. Again, it's
less
like,
risk.
Yeah.
You can get less down. It is a great tool and vehicle for times like today because of what interest rates have done. So when interest rates were really low, like we could not get sellers to do it because everybody had access to money.
Yep.
Interest rate was cheap and low. So why would you even do it? No, just give me the money, right? Whereas today, financing is hard. That is an opportunity for you buying.
Exactly right, man. Well, we've touched a lot on seller finance, seller carry. Let's talk SBA.
Yes.
SBA, how do you feel about it, man?
So SBA, there are big pros and cons. SBA loans, typically these are small business loans. So the benefits of SBA loans is that you can put much less down. Like we're talking, 10% down. Now, one of the problems with the SBA loans today with higher interest rates is because the interest rate's higher, that hurts the debt coverage ratio. What that means is how much is your monthly payments in debt compared to how much the revenue is or how much it's worth. Because interest rates are higher, that means those payments are higher, so it doesn't meet their coverage ratio. The revenue needs to be able to cover that debt. That is why when you look at it, like we do not have a lot of debt and we put a lot down. It's because of that debt coverage ratio, especially when interest rates are high.
And they're typically looking for like a 1.25?
Yeah,
debt service coverage
about that
ratio?
Yeah, that's about right. And when you look at the SBA, you have the opportunity to put low down. For example, let's say it's 20%. Well, if you went out and got a regular loan, you may be at 40. So it could be half. And this is a way for people, especially getting started, to access great loans that are small business loans that are backed by the government. That's why banks will do it, right? And allow you to do it. Now, when we look at SBA loans, the downsides are a couple things. First of all, the downsides are you have to do it right. Meaning if you went to your local bank to get an SBA loan, what the local bank will do, you have to fill out all of this paperwork because it has to get approved, like by the government. So the salesperson at the bank may go, yeah, we can do that. Then you do all this work for 2 months. They submit it. It comes back a month later. Now you're 3-4 months into it. And they're like, nope, it was rejected. And you're like, wait, what?
Yeah.
Right? Like
and this whole time you've had
this
a
whole
seller
time,
on the hook.
yeah.
Like,
And you can get into trouble that way.
Yeah.
Now, how you avoid this part, this is why Live Oak Bank is a sponsor. And this is why we use them, because they have what I call the PIN, meaning all it means is they're actually the entity that approves SBA loans for the government. So when they say this will work as an SBA loan, it will, because they're the ones that approve it. Yeah. So, they are the final. And because they are the largest SBA lender in the United States, and they have their own self-storage department. So they underwrite it. So if I'm doing an SBA loan, I'm just going to be frank. That's who I'm going with.
Dude, I was going to say, shameless plug, dude. Like
shameless plug. And it's just true.
Yeah.
The amount of time that they can do it in, it's a fraction of the time. More importantly for me though, they will do the underwriting with us. They'll help us, but they'll tell me if it doesn't work. They're going to say this won't be approved.
They'll
you
even do site visits, all those things. They'll come out and look at this stuff with you side by side. Truly incredible organization.
And that's the biggest hurdle. The biggest hurdle is that you won't get it approved.
Yeah.
So that's SBA loans scare me for that reason.
By people that don't understand storage.
Yes, exactly. Yeah. And can't tell you if the government will approve it or not. They don't know. And to me, that's the biggest downside to SBA loans. Live Oak Bank, you get over that with them. Now, one of the other things though that is a downside with SBA loans, it's good because it can give you a great loan, right? You get cheap down. It's a small business loan, but a lot of times they will not allow you to pay it off early. That's a big downside. So you can't go, all right, I have a 10-year loan here, but I want to pay it off early. Now, why would you want to pay it off early? There's a lot of reasons. But one of the main reason is, let's say you're at an 8% interest rate and interest rates go down to 4. You're like, I want to refinance. Right? Nope, you can't do that. We're not going to refinance you at a lower line. So one of the things that I want with my SBA loan is if we do have prepayment penalties, I want it like 1 to 2 years. Like, okay, I'll take prepayment penalties for 1 to 2 years because we got to buy it. It's got to stabilize anyways. But after that, I don't want prepayment penalties. That can be a hard thing to get with SBA loans. They do have them. I know that there's products that allow it, but sometimes they don't. And that's a big thing for me. I don't want those prepayment penalties.
Yeah, that's a good point. Do you, in those circumstances, I know this is kind of a loaded question. There's a lot that goes into it, but is one of your focuses to pay down debt as quickly as possible, no matter if it's an SBA loan or conventional? Like, is that a major goal of yours?
No, not necessarily. So once again, we already go in with so little debt, and debt is a form to get returns. Like if you paid in cash, your returns are going to be really, really low. So when you have a real estate asset and you're putting, this isn't apartments, right? Where you're putting 90% debt on it. Like, no, not at all. We have low debt. We have good, consistent cash flow. So we want to make sure that our returns are higher because we're putting less down. So our actual returns are better for it. This also gives us a whole lot of other advantages, right? Tax advantages, all sorts of stuff. Leverage is very key to real estate. Now, when leverage is done wrong, it's bad. And that's why you have to be careful with it. And this is what we saw. We were in the business prior to 2008 and afterwards. And we saw a lot of this in 2008. Interest rates have been causing the problems today. But if you have low leverage, then, it is a fantastic tool to use. And it almost a necessary tool to get the returns, because somebody else could buy it and pay a higher price because they get a better return with leverage. So it's very difficult to get deals. Mm-hmm. Now, if you want to go buy, and two, especially when you're dealing with small facilities, I actually like the idea that you would pay in cash and then maybe take debt on it later. Our key idea, though, is we're trying to improve the asset, not just pay off debt. Mm-hmm. And we'll actually refinance it. So one of the problems we have is our debt gets so low, the return on our equity is lower. Meaning now all of a sudden I have $1 million in equity when I had put $500,000 in before. But now that I have $1 million in equity, my return on that $1 million is lower because the debt didn't change. So the debt is so small. So then we want to refinance and get that new loan on it, which is still really low. It's still 40% down, right? So you're not over leveraging anything at all. It just maintains where it was. And so we would want to do that. That also gives you the benefit for you and your partners, everybody else, because that loan that you get, it's like taking the equity or the profit out, but it comes tax-free.
Because it's debt.
Because it's debt.
Yep.
Now, at the end of the day, right, you would never want to do that if you took too much debt out. But you can't. There's no bank, and especially at today's interest rates, that would allow you to do that. I mean, if we're talking about like a hard money lender, that may be different. Do not do that. And don't go down that road.
No, exactly right, man. Really good stuff, because I wanted to make sure and touch on that. I remember, man, almost a decade ago when I first met you, probably a decade now, but that was one of the things I remember talking to you about. I'd nonchalantly had said like, "Oh yeah, you probably want to pay those off pretty fast, huh?" And you're like, "Well, actually, not really."
Nope, nope, we don't.
And I was like, "Wait a second, my whole life has been a lie. Like, what are we talking about?"
Nope,
dude, I freaking love it. One of the things too, when we're talking to SBA loans and those, I wanted to touch on this idea of tying in your working capital, because when you acquire those assets, you're going to need some of that working capital for a set period of time for improvements, for your operations, those different things. You can really get yourself into a pickle if you just go and you're doing the bare minimum. Make sure you're tying in that working capital. And then on top of that, getting a line of credit alongside that working capital. So it's a totally different thing. So you've got your SBA loan with the working capital, and then you've got this totally separate revolving line of credit that you can pull on any point in time. I've seen instances where people can get really great setups where they might have had, the loan and some working capital of, let's say it was working capital of 50 grand, but when they did the line of credit, they got like, a working capital in the loan of like 40 grand, and then they got like another 50 grand of a line of credit. So they actually ended up having way more money that they could utilize for that initial, few months of operations to turn things around.
Really important and I've seen a lot of people make this mistake. I've said this a million times, and I don't care who it is. People, for some reason, do not understand. These are not ATMs.
Yeah.
This is a business. Cash flow doesn't just come out and you pay. That's not how this works. And you had a lot of problems with people that would fund returns, meaning you would take money and then just pay out as distributions and act like it's a return, but the asset wasn't actually producing it. You were just taking money that you'd borrowed and paid it out.
Giving it back.
Working capital, why it is so important. When you buy that asset, you have to transfer it. You have to change names. You have to do all of this kind of stuff. Self-storage is seasonal. So that means revenue is not consistent. Every month it is different. So lots of times you buy the asset and all of a sudden, even though your projections were right, you have 5-6 months where it's either down lower than you thought or negative. And then you had all these startup costs that you did not think of or predict. And then you have no capital. This isn't like, I go buy a property that's $1 million. I put $200,000 and I just get a check in the mail. It's not an ATM, right? It's not a bond. And the market changes, and it changes dramatically. We've got killed in the self-storage industry over the last 3 years.
Oh, dude, what did street rates do?
Street rates plummeted.
Dude.
We had some of them that went down 60%, right? You just can't know or predict these things. And when you're starting out, it always takes more time and money. So if all you're thinking about is the loan and just expecting the property to pay for everything, people are always shocked, surprised, then they got to go out and get more money.
Dude, yeah, that's
working capital. You buy property, you have $300,000. You can pay to contractors. You change the signage. You get everything updated. You do the things that you maybe need, whether that's CapEx or not even CapEx, just things you have to change. You pay vendors off. Maybe you got to get rid of delinquencies, and so your occupancy drops
because
you got to clean it. There's all this different stuff. And if you didn't have working capital, you have no money to do it. Then if you have no money to do it, you get into big trouble because now all of a sudden, let's say revenue dips or that you have to pay that stuff and you don't have the money to do it. That creates a cycle downwards. Now the asset isn't getting the money it needs. It's not performing as well. That means rents and occupancies drop. Now you don't have money to put in for ads, so you can't get working capital, which is simply capital sitting in the bank to stabilize the asset, getting it run, is just important as anything else. How that normally works, if I'm buying a property for $1 million, okay, what we'll do is we'll say, all right, the actual cost of the property and how much I have to put down is $1 million. But we have all these other things, signage, we have delinquencies. We don't know exactly how it's going to perform. When you buy it, it's different than looking at it on an Excel spreadsheet. I know it's surprising. And markets may turn down. So then we say we got $200,000 that we're sitting in a bank account here to do all of these things. That means then my loan is $1.2 million. And remember, the thing about working capital, if you don't use it, you can disperse it back. So you can get it back. But you can't get it once it's done and once the loan's there. Working capital is really important. It's a business. It's not a bond. It's not an ATM. Markets change. Things happen. You cannot expect things to go perfect because they never do.
No, they never do, man. And it's such an eye-opening thing, I think, for a lot of people is there is in so many industries, in storage and all these things, the seasonality aspect, the ups and downs of certain expenses You might
Yeah.
have really high utilities a certain month, or this, or some random thing happens. You get a pipe that bursts at a facility.
Your tax come in 50,000 higher than you thought it was. Utilities
real.
jumps up.
Yeah.
All of this stuff
All the surprises,
that
man.
you don't even know and you can't even predict. That is
Exactly.
normal parts of business.
Yeah, and just having that, I don't want to say slush fund, but
Yeah.
just having those funds available to you and being able to lay your head down on your pillow at night and go to sleep.
Yes.
So much value in that.
So much value.
Like, tie it in there, dude.
Yep.
Oh, man. Cool. All right, man. So let's talk private money, partners, things like that. A lot of people they want to bring in a partner. So they're like, okay, do I give them equity, or do I how do I make them a partner, or how do I let's say they're going to come in and bring the 10% down that I need for my SBA loan. How does that work? What does that look like? When do I give up equity? When do I don't? What are some things that you've seen?
There's a lot of ways to do this. The unique thing about us and our company is we were independently wealthy. So we actually made a lot of our money in insurance businesses and doing storage facilities for 15 years on our own. We took all the risk, we invested, we did everything else. In fact, investors are very new. The vast majority of properties, even though we don't stuff, it's just personal. They're our money, our debts, our liability, our companies, right? Everything else. When we had investors come in, we didn't build our company off investors, right? We talked about how like they just got to come along with us. The first thing that you need to remember is when you take investors or private money, you are giving them an opportunity to do the same thing you're doing, which is investing and risking your money, right? So we put our money right alongside investors. In fact, we're buying these great properties due to interest rates right now, and the vast majority of the money that's going in is us. It's not the investors. We did a self-storage conversion that was in Boise, Idaho. Amazing deal. We bought it for really, really cheap, the building, but then we built and turned into a facility. The whole project was like 18 million. We put a lot down, like over 40%, and maybe 50% LTV. So there's not a lot of debt on it, but the vast majority of all the capital, like 80%, is us and our partners, our two partners. That's it. The investors then came and went alongside us. So they have the same opportunity to invest in something for the long haul to make money. It does not work like an ATM, things like that. You need to realize that when you're working with private money, and it's an opportunity. It is not a guarantee, and there are risks. We have properties that we put money into, right? Everything else, rates collapsed in the market, and we got to hold on. Now, we've never done a capital call to investors. We've never lost a property, things like that. But they didn't perform anything close to what we thought they were. We had to pause distributions on one. We had other ones. The last 3 years have taken out a lot of self-storage operators. And what happens when you don't have that private money, and when you don't have it, you only have a couple options. So for us, we could fund our businesses and not need to take like some fees and different things for the investors, therefore not draining the accounts. And we didn't have to do what's called a capital call, which means then you got to go, because if you are the entity and your investors are the money, when there's no money, when rates drop, and what do? You got to go to the investors and say, we need more money.
Yeah.
Right? That's a capital call. So you need to make sure when you're working with private money and private lenders that they realize this is not a bond. This is why we only work with accredited investors, right? And we work that you get this opportunity. I posted a chart that showed like the market since like the 1920s or different things like that. And like, this is a long-term game. So you need to make sure that you're working with private money and partners that are in it to build a business, and realizing that there are times in the market where the market not only goes sideways, it tanks. That's how it works. You guys need to be prepared, understand, and realize that. With that said, right, that is the beauty and the great part of partnering with people. You are giving other people the opportunity to do the same thing you're doing, risking your money, and you can now get capital to do more, do cooler projects, as in bigger projects that have more potential, all of these different things. And you're giving an opportunity for people that wouldn't have it. So you're creating these opportunities. And then they get to make the personal choice if they want to risk, if they want to do that, and put in. But you have to do it right. You have to follow all the laws. You got to do that correctly. You got to work with attorneys. We're not attorneys. You need to work with actual attorneys that fund it and build out these documents.
Yep.
So there's two parts of private money. One is the investor part, which we're talking about now, meaning you buy $1 million facility, you need to put 30% down. That's $300,000. You're like, I have $50,000. But I need $250,000. So you get friends, family, and they all put their money together to take advantage of that opportunity. Something goes wrong, the investors, you don't have money, they have to put money up. They have to give money now because it's short. That's called a capital call, right? And that's something that, once again, we've never done and been able to avoid because of how we were set up. You want to realize, though, and talk with people, this is a business, this is how it works. You have your not slush fund, but that working capital to make sure things go smoothly, that you get it. But you can all do this and do this together. And that provides an opportunity that maybe you couldn't have taken down on your own. An amazing opportunity, an amazing thing for people that have extra money, want to get in the game, they can do. Now, there's another side, though, of private money and borrowing. And that's like hard money lenders, okay? Or short form, where you are actually borrowing from a person.
Like you're not bringing them in as
an
equity.
Investor, like as if they were a bank. They're like, I will give you the $800,000 and you're going to pay me a 10% interest rate. Hard money lending is always a much higher interest rate. But this can give you a good opportunity to maybe, if you couldn't get a bank or you need to close it faster, you want to do a deal right, to have access to it. And if the deal works,
my kids,
it's great.
They do this all the time. They'll go to the store and be like, hey, I don't have my money, but hey, brother, sister, like, I know you got $10. Can you buy that for me? I'll give you 12
exactly.
when we get home.
Exactly. And hope they forget about it.
Yeah, exactly. Right. And then they're like, oh, I don't have $12. Sorry.
So this can be a good option. You have to be careful when you're dealing with hard money lenders, things. That is not something that we utilize. In fact, the hard money lenders are us, except we normally don't like charge interest rate or hardly interest rate at all because we use our capital to move deals. The reason why you have to be careful is very similar to the seller carry. This is a private person, right? The interest rates are generally higher. And it is, you do not have protections like you would for the bank.
So you'd have those three same rules, not personally guaranteeing those.
Yeah, that can be harder though, because like if it's a
work?
Lender, they're probably going to go, no, you have to.
Yeah.
This is a loan.
Like
this
the
isn't.
asset wouldn't.
Yeah. Like I'm giving you the whole entire money for this, because they are acting as a bank. Now they may not, but that's going to so widely depend because there's hard money lenders everywhere.
Yeah.
But it can be an amazing opportunity and option. If you have a good deal, high cash flowing, I've seen people, I never have, but I've seen people, they get a bank loan, use a hard money loan for the money down. One of the problems you have today is if you do that, you have to disclose that to the bank. And I've seen people not do that. That is really, really bad. Really bad. Do not do that, right? That is
they're pretending
banking
like
fraud.
that's their down payment, like they didn't
that's their
borrow
money
it from someone?
Yes.
Ooh, yeah,
or
that's
they'll
not good.
do what's called like cross-collateralizing assets. They'll take money from one asset and move it to another. That's also something we don't do, never have done. And you've got to be really careful with that because the banks, that money going into it, it needs to be cash. If it's not, they need to know exactly where it came from, how much it is. Remember, when you have an asset, it's its own thing. Think of it, it's its own business, its own world, own LLC, own banking, own debt. You do not want to be moving money around, right? So you got to look at these things. You got to be really careful about it. But at the end of the day, banks aren't going to, today, they're not going to let you do those things.
Yeah, well,
especially today.
You don't want to be piercing the corporate veil, man. There's no going back. Once it's pierced, it's over. You're opening yourself up to a ton of risk. It makes me think too, on the SBA side note, talking to some lenders, in this down payment situation, they're going to be wanting to track exactly where those down payments come from. So they'll ask for bank statements, and they'll want to see
they're going to want to see it all.
The paper trail. How did you get this down payment? And one of the things, so if you're going to go in and bring partners in on an SBA deal, let's say your partners are going to bring that 10% down. Those partners are going to have to show where they got that money. And then on top of that, you cannot, as of right now, I don't know if that'll ever change, but as of right now, you cannot utilize a loan of any kind for the down payment on SBA.
Yeah.
It has to come from somebody who has it. You bring them in as partners. It's not a loan of any kind. So that's just a side note on that came to mind as we're talking about this down payment partner situation.
And when you get into this, there's lots of ways that you can, when you're using investors, you could theoretically just like do it in cash. So even like when we're talking about that Curtis building, things like that, we just went and bought it, right? And when you're dealing with different types of properties, so for us, for a conversion, there's different processes in loan. So we bought the property, pay for it, but then you got to get a construction loan. So you buy the property, we took a loan out after we bought it, like, okay, we're going to do this. We're waiting for the construction loan, everything to get done. That's a year. Then you get a construction loan. Now you have a construction loan, right? And then you get your final loan, which is a perm loan, which is your traditional final, which just rolls those other loans into it. And then you just have one single loan like we did there. So there's all these ways that depending on it, you can do it. Now, you have to work with CPAs and attorneys and obviously the banks, because every bank is different in what they are going to require and what they're going to want. Lots of people, what they'll do is, especially when it's quick and needs to be, that's where you use the hard money lender. And that could be an awesome option. Hard money lenders can be great short-term options.
Kind of a bridge.
Because, it's a bridge, exactly. A bridge loan, right? You need to get something from here. The bank loans and paperwork are going to take a lot of times. I know lots of people that don't even need it use hard money lenders to just go, oh, I'm going to go buy this land. Then because we got to do it quick. We have this great opportunity. Then we're going to pay it off with the loan or the construction and then move forward. So they'll actually jump. They'll start maybe with a hard money loan. Then they will get a loan on the property, pay back the hard money loan. Then they'll get a construction loan to build it. And then they wrap everything up into the permanent loan when the property's all built and done. You got a 4-year time frame, you got 4 different loans, but at the end you end up with one. And that's totally common and normal. And that's where I think hard money lenders are really good. Bridge loans or short-term loans as you are working on your permanent loans and financing.
How does that work to, let's say you, like on a development project, this is something I'm just thinking of here. Let's say you are, 3 years out, 4 years out, and when you get to that perm loan stage, is there any ability you have to affect or secure interest rates on that perm loan once you get to that point, or when you get there, it just is what it is?
So we've done, and funny enough, I actually did this when building several things. Like we locked in our interest rate at the construction, and the construction loan would roll into a perm loan with the locked in interest rate. The downside to that is usually you're going to pay a premium for it. So now we did this, and that turned out to be amazing because we paid a premium, like it was, instead of 3%, it was 4%. But then when it got done, the interest rate was actually 8%. So we're like, that was amazing. That was great, right? So that works out really, really well.
But figured out.
So there are ways that you can do that. Once again, this will depend on the bank and who you're using.
Gotcha.
This is all very regulated. The banks are, and financing in general, the documentation is wild, right? So like we have about a $32 million loan. It is on personal assets that we have, personal portfolio, that is a $32 million loan, and it's $100 million in assets. So it's only 32% or whatever it is, right? We don't have investors, anything else like that in this. It's just a loan. That loan we actually put on, and we did what is called a CMBS loan. That is a non-recourse loan that's constructed into a bond and sold on the bond market. So it's a non-recourse loan, meaning if something went bad, they don't get to go after our personal assets, right? That is how the vast majority of commercial real estate is actually done. Large loans are done in the CMBS. I don't know, probably 90%. The qualifications for those CMBS loans or non-recourse loans, it changes, but it's usually a substantial amount. Meaning, like if you're doing like 500,000, they're not going to do it. It needs to be like you see it a lot in 5 million plus loans,
gotcha.
but there's a lot more rules and cost to doing that. So for us, we had good, solid, stabilized assets that we weren't going to touch. We'd already done our value add, refinanced. They were just cruising. We moved it into a CMBS loan to lock in the interest rates, which were really low, have it non-recourse, and it was a low amount of debt on the assets, very low. And that was perfect. That makes it just that debt portion cruise control. I don't have to worry about those things.
Devil you know.
Yep, exactly. Now, if you have lower ones, though, lots of times, not only do you not have access to it, but a lot of times it doesn't make sense to do it. The reason why it doesn't make sense to do it, you can't just repay it. It is way more restrictive. You have to hold cash in counts. You have to do all of this stuff because now the asset is the only guarantee of the loan. So there's tons of requirements associated with it. That's why it makes sense usually when you're doing bigger loans and you're working, but not smaller. But those non-recourse loans you can actually do too with not just CMBS loans. You can do with like life insurance companies, for example. They'll do it. Generally speaking, what we see is they want way more down because once again, the asset's the only thing that guarantees it. So you're not putting a lot of debt on it. They're going to want 40, 45% down on it to get that. And then they're going to want you to hold a lot of cash reserves and things in the asset at all times that protect it.
Gotcha. They don't want that risk.
That's right.
Love it,
That's
man.
right.
Well, cool, dude. Thanks for sharing all that. That was fantastic.
Yeah.
Good info.
A lot of options,
Dude.
Lots of ways to go
Endless.
with it. We've hit the no-goes, what you don't do. And debt is a instrument in commercial real estate that is, I don't think I know anybody that doesn't have debt or use debt. You can't get your returns, especially in storage, stable cash flows, right? That's a method and a means that we do real estate, right? But you also have to be careful with it. Storage, just by the nature of our asset class, the banks and regulators, we have to put a lot down. If you move into other asset classes, you can really jack that debt up, right? And have a lot of debt. We don't do that and can't do that in storage because those products just aren't really offered. The best we can do and what you can do to get the least amount paid is through the SBA loans, but the SBA loans also cap out at a certain amount. I don't remember exactly what it is, probably like 5 million.
I think it's 5.
Like 5 million.
Yeah.
And then above that, they don't do it. So generally our projects over 5 million, we don't utilize SBA loans today.
Yeah, chump change.
That's right.
Anyways, awesome, guys. Hey, thanks for hanging out. If you haven't yet, please leave us reviews. We could use those always.
That helps us, everybody.
Yes. Thanks so much for tuning in. We'll catch you guys next time.
Thanks. Talk soon.